Got a photo up here of one of my favorite movies of all time. You guys might be a little bit younger than me, Good, Bad, the Ugly. But it's basically just lessons learned, the good and the bad and the ugly of real estate, and how to master it while being cautious and, having some sort of peace of mind while you're doing so. So just a couple of points I really want to kind of get into briefly. And those are, one, don't believe everything you hear. Know the risks. Take your time with each investment you do. Partner with experienced sponsors. Understand the tax implications. And most importantly, to me at least, from what we see with investors, is define the goal and the objective. So to start with the first one, and a lot of I had mentioned a lot of the stuff that we kind of talking about here is stuff we've spoken with investors over the last couple of years, things that have come up because social media, all the information that's available online, there's a lot of information. Some of it is accurate, some of it is false. Some of it is in the gray area. There's a lot to see and digest, and sometimes it can be overwhelming. So we were trying to put together basic guidelines to really kind of help slow things down when you're looking at it. The biggest thing of all is, avoid the FOMO, where it's just, real estate is not like trading, meme stocks or coins. It's something you really need to have a good understanding on. Be careful of the videos, the YouTube videos, and the get rich and retire on one deal type unicorns. Typically they don't end up that way. And just, like I said, question what you read, both the good and the bad, and be objective. In real estate in general, there are no guarantees. It's a fluid business that has ups and downs in the course of an investment offering. So you should be aware of that. And, with every deal, not everything will go as planned. If you were able to chart, a 3-year or 5-year offering, it will have the ups and downs, but, the goal is to end on the up and work through the issues. That's why working with someone experienced, I think, is helpful. And like always, speak with other investors, dig into the forums, like we enjoy looking at them, getting kind of concepts of what people are looking for, what they're interested in, what they're concerned about. So we try to pay attention to that stuff as well. First part is really, just know the risks before you get involved. There's a lot of different variables that come into real estate. You have the market risk, which has been prominent in the last, I would say from 2020 to 2024, which you had interest rate fluctuations, COVID, demands in housing shifting from city to city. So that was a pretty impactful part of the last 5 years. Asset risk, the kind of deals that you're looking at. What are you doing? Are you doing ground up construction? Are you doing rehabs? Is it a lipstick renovation? They're not all the same, though they are advertised as the same. So you should really have an understanding of what you're looking at and what's involved. The financial risk, that can arise from lending rates, higher than expected financing costs, liquidity, with any deal, you're going to, especially the last couple of years with rates going up, projects needed liquidity and deals needed liquidity to kind of manage and work through the crisis. And inflation, again, another one that's been popular the last few years. So you have to really try to understand it. With any deal in real estate, you seek high teen, low 20% returns annually on a real estate investment. So you have to understand that there's risk involved, and it takes careful planning to reposition and develop an asset or a fund or a deal. So it's important to know the obstacles. Take your time is another one. Just take a look at it from a long-term perspective. The deals that are the shiny ones are usually the ones that don't go well. It's the ones that are steady and make progress on a daily basis or monthly basis are the ones that really do well. Diversify. Don't put all your eggs in one basket. And most importantly, I think understand the investor accreditation process. With any investor that works with us and many other sponsors, they're accredited. So there's a little bit of homework you have to do that, but I think it's something really important. And because real estate it's illiquid. And once an investment has been placed and an asset has been purchased or a fund has started to make purchases, the money's locked in there till the end of the project. Partner with experience. It's important to know who is the sponsor that you're working with, um, and really kind of asking them just basic questions about what they do. How long have they been in business is the easy one. Um, there's new people coming into the business at all time, which is good because it keeps it thriving. You see new things that kind of come to into effect, new strategies that might not have been in place earlier. So it's always good, but that comes with a little more risk when you have newer sponsors. My preference, or with everyone is kind of talking about the times when the market was not good. Lehman, was something we went through. September 11th here in New York was something I went through. So it's just, once you see a couple of crashes when things are really bad, you can understand what's involved and how to navigate it, and build in systems into what you do on a day-to-day basis to work against those. Yeah, and it's for us, I think that's a good way to protect capital when the market is volatile, or kind of things shift in the negative direction. A couple other parts of this is just general market presence. Is the sponsor that you're working with in the city that they're is there a presence other than a Google map or some data metrics that they get online for them to really analyze the deal? We work in New York because it's where I'm most comfortable. If I take a neighborhood in Manhattan, Brooklyn, or Queens, I know the 25-year history of that area. I can probably tell you the comps on the rental and the sale side. And I've seen what things have gone on, and I understand the bureaucracy and the process to get deals done in New York. So I stick to, that's my spot. Track record, is also important. Just understand what deals went well, which ones didn't. A sponsor should be able to share it and discuss, all the deals that are on there. Why did this one? Why did X perform this way? Why did Y perform another way? Sponsors, as always, should have skin in the game, whether it's their capital or providing the guarantees on the senior debt. Those are both important. For us, usually we put a co-investment on each deal, but I also provide the personal guarantee on the senior debt, so that regardless of what happens, I'm focused on getting a deal done successfully, because my house is part of the personal guarantee. So it's as simple as that. And another one that's kind of come up recently that we've seen a bit, I've seen investors ask about, is liquidity. Over the last couple of years, with rates spiking, the biggest issue that put a lot of deals into bankruptcy and default was liquidity or lack of reserves. You can't do a capital call on a deal when it's going down. It's very difficult to do that, just because why would someone want to put bad money after good, or good money after bad? So it's just kind of, you have to have a sponsor that's going to be willing to and able to fill the cash reserves when needed. When things get tight, or there's a lender that's delaying a funding event, you need someone that can come in to fill that void. Otherwise, it ends up in a negative situation. Another one is understand the tax implications of each deal that you look at, and this kind of ties into the next side of slides as well. But with the tax benefits, what's your objective? Are you looking for something to depreciate? Are you using depreciation? Or are you looking to invest with a self-directed IRA? Are you looking for a 1031 exchange? Or you're looking for bonus depreciation? What kind of income are you trying to offset? Is it a W-2 gain? Is it an investment gain that you made this year that you're trying to offset with something else? Is it saving for retirement? And trying to defer taxes in that respect. So there's a lot of different ways you could do it, but I think it's just understanding what the objective are. The self-directed IRA has been the most popular thing in the last couple of years. That comes up often, and we've had people use that more and more as time goes on. And then define the goal. Like I was saying, what's the objective on your investment strategy? Are you looking to just grow your savings? If you want to put money into a deal and just get a certain, target a certain return? Are you looking for passive income or cash flow over the course of an investment period, where you want to get a check in the mail quarterly? Are you looking for the tax benefits, like we just discussed, to offset, one of the, some other event or financial event in your life? Or are you just looking for diversification where you can have a large amount of, your more traditional Vanguard mutual funds, and you're looking for a small allocation into real estate to diversify just your general portfolio? That's something that comes up a lot, and I think that makes a lot of sense. Or are you looking for something for an inflation hedge? As cost of living goes up, and if certain other investment vehicles don't track that as well, will real estate kind of help you to kind of blend that a bit? So those are a couple things just to look at.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.